Canada's economy is wobbling. Markets and mortgage holders are screaming for relief. And on September 17th, the Bank of Canada is about to show its hand, with the odds of a rate cut pretty high. The overnight rate is sitting at 2.75%. Markets are pricing in a 25 basis points cut on September 17th and another one for next quarter. But here's the kicker. Inflation data is coming out on the 16th, and if that runs a little bit hotter than the Bank of Canada likes, then the odds of that rate cut come down quite a bit, and it might not come back up into conversation for another couple of months. Why? Because cutting into higher inflation isn't stimulus, it's monetary policy error. 5-year Canada bond yield already slid to 2.75%. Translation: bond markets are saying that cuts are coming. Mortgage lenders are watching this like hawks, especially at this mortgage renewal wave from people that purchased in 2020, 2021 that are coming up for renewal, as well as new mortgage originators for people that are looking to get into the market, especially given the low number of sales and the massive number of active listings. But if inflation pops, that optimism gets rug pulled pretty fast. And with 66,000 jobs lost in August and unemployment at 7.1%, Bank of Canada almost has to act unless inflation gives them an excuse not to. Because cutting rates makes borrowing cheaper, aka demand goes up. That's totally fine when inflation is falling. But if prices are still running hot, it looks like the Bank of Canada is adding fuel on the fire. And if there's one thing that the Bank of Canada fears more than a recession, it's losing credibility on inflation. That's why even one hot CPI print can delay the rate cut party. So here's the play. If inflation undershoots, cuts are basically baked in. But if it overshoots, the Bank of Canada will hit the pause button and call it a data-driven decision.